You're playing the investing game on hard mode, but I have the cheat codes. I've helped millions improve their finances, and I'll show you how to escape 4 common investing traps so you can stop stressing and start building wealth, even if you're starting from zero. A lot of people don't know this. Most pro investors can't beat the market. That's why index funds are such a smart choice. They're like the easy mode of investing. An index fund is a bundle of hundreds of top companies. So instead of guessing which stock will win, you own a small piece of all of them. The S&P 500, for example, includes 500 big names like Apple, Amazon, and Google. And here's the magic. If you invest just $150 a month in an index fund, starting when you're 20, you'd retire with over $2 million. That's the power of compound growth. Your money makes more money over time. And don't worry about market crashes. The market always bounces back. Index funds help you ride the ups and downs without freaking out. If your job offers a 401k match and you're not using it, you're literally leaving free money on the table. Here's how it works. Let's say your job matches 5% of your salary and you make $50,000 a year. If you put in $2,500, they'll add another $2,500. Boom! That's an immediate 100% return on your investment and a cool $5,000 going into your retirement, only half of which came from your own pocket. Even better, the money you contribute is pre-tax. That means it lowers your tax bill and the investments grow tax-free until your retirement. People say, I can't afford to save, but because it's taken out before taxes, a $100 contribution feels like only $70 or $80 missing from your paycheck. So if you haven't already, start 401k contributions now. The earlier you begin, the more time your money has to grow. Worried about investing at the wrong time? Don't be. Dollar cost averaging is your secret weapon. All it means is this. Invest the same amount of money on a regular schedule, like $200 every month, no matter what's going on in the market. Here's why it works. When prices are low, your $200 buys more shares. When prices are high, you buy fewer. Over time, you get a better average price. Plus, you don't have to guess when to invest. You just stay consistent. Even better, you can set it up to happen automatically on payday. No stress, no overthinking, just steady growth. And when the market crashes, don't panic. It's like a sale. Stocks are on discount, and that's when you're actually getting the best deals. When you're young, you can take more risks with your investments, but as you get closer to retirement, you need to play it safer. So how should you divide your investments to balance growth and safety? Here's an easy rule. Take 120 and subtract your age. That's the percentage of your money that should be invested in stocks. So if you're 30, you'd have 90% in stocks and 10% in bonds. And if you're 60, maybe 60% in stocks and 40% in bonds. Why? Because when you're younger, you have time to recover from market drops. But when you're older, a crash could ruin your retirement plans. If all this sounds too complicated, don't worry. There's a super easy solution. Target date funds. You just pick the year you plan to retire, and the fund automatically adjusts the stock-bond allocation over time. Just set it and forget it. Now you know the 4 steps you must take to stop investing on hard mode, but knowing isn't enough. You have to take action. Watch the video on your screen to start investing now on easy mode.